Welcome to another installment of the Gabelli podcast. My name is Jeff Illustrato, and my team and I oversee investor relations and business development for our firm's merger arbitrage strategy. Who better to join us on the topic and other anecdotes of Wall Street, Kate Welling. Kate has, for the past 20 years, led the independent research journal Welling on Wall Street. Many of you also know her for many years at Barron's, having worked side by side with Alan Abelson as managing editor and notably coordinating the Barron's annual and semi-annual roundtable issues consisting of interviews of Wall Street's investment masters. Speaking of masters, I'd be remiss not to mention her 2018 authorship with Mario Gabelli of Merger Masters, Tales of Arbitrage, which chronicles stories from the likes of John Paulson, Paul Singer. It also explores the perspectives of CEOs, including Bill Stieritz and Paul Montrone, who have also been at the crossroads and frankly the crosshairs of investment banks, activists, lawyers, and the arbitrage community alike. It is our distinct privilege to welcome Kate to the Gabelli podcast. Welcome, Kate.
Thank you. Thank you for having me. It's a pleasure to have this opportunity to chat.
Of course. Thank you. Perhaps as we begin, maybe you can share your high-level thoughts as you have a dialogue consistently with those in the investment community from a variety of angles. What really are the biggest risks or challenges that you see ahead for the markets as we look to 2022?
I'll be glad to, with the caveat that, that the challenges that you see coming are rarely the ones that end up kicking you in the butt. They sneak up on you one way or another. But obviously the markets are at high multiples at this point. We don't know. Hopefully we're finished or nearing the end of our epic battle with COVID, but proven itself to be a sneaky adversary, so I'm not willing to say that that's entirely over or its economic disruptions. And even if what we're facing is not a multiple crisis or the other thing is the economy is for all of the good numbers it puts up some troubling numbers too. And it's never gone through quite an experience like it's been through in the last couple of years. So we really don't know how that's going to, how that all is going to play out. And even a change in market leadership is not something that maybe what we're dealing with now is not something that usually happens seamlessly. So I'm, I guess I would say, on the alert for anything and just don't know quite what it might be.
Sure. All good points. And maybe just to segue a little bit in talking about the marketplace and its participants and how they all work together or perhaps not together in certain times. At one point, high-speed trading was really the kind of the talk of the street. We don't see a lot of news on that currently, but clearly we know that still exists. And that high-speed frequency traders are players in the market. And now we see a lot of talk about retail, who always have existed, by the way, also no difference there. But clearly some nuances of what's happening now is the chatter on message boards, looking for links between the markets, the broad equity markets and the price of various cryptocurrencies. So really, I guess the question would be, what do we make of the retail, quote unquote, retail day trader today, who perhaps now has a voice as a market participant that some argue they really didn't have before?
Very good question. I don't want to sound disrespectful in any way of individual investors. For 25 years at Barron's, they were some of our most loyal subscribers and great people to serve. And I even have managed to keep some as subscribers to my institutionally focused newsletter. But there's a big difference in my view between an individual investor and the fad for speculation that has gripped the younger segment of the population, I guess, or at least the ones who just naturally have fallen into this gamification of the market, the ability to go on with commission-free trades on their chat boards and venues like Robinhood and play literally in a gamified stock market environment. They're not investing on anything that could be ever recognized as fundamentals. And the kinds of transactions that evidently go on, and I've gone online and looked at some of this, between the chat boards and the players. It's stuff that in years past technology didn't accommodate itself to nearly as well. You had to use landline telephones, but when you boil down the essence of what's going on, it's no different than some of the boiler shops in the 70s were doing with in-person meetings and landline telephone tips, trying to manipulate stocks. At some point, the regulators are always a day late and a dollar short, to say the least, and so they'll catch up, but I don't think much of the trend.
Sure. No, understood. Thanks for that. Let me just change the topic a little bit into more of a specific area that we both know well, and that's M&A. And for those of you listening out there, here at Gabelli, investing in announced deals is really core to our process, and more explicitly in the investment vehicles that we have that are dedicated solely to extracting value from the time a deal is announced until its ultimate closure, should all the deal hurdles clear, of course. 2021 will wind up as the 8th consecutive year with over $3 trillion in deal activity announced globally. And despite some headwinds on the regulatory front gravitating in the headlines recently, Kate, what do you see still propelling this deal rally?
Well, the quick and dirty and easy answer is cheap money, which there has continued to be. I mean, has there ever been a string of 8 years in a row of record high or near record highs deal making in the deal business? You probably have to go back to the 80s to come to any kind of comparable stretch. Also, going along with retail traders, we were just talking about are very happy with instant gratification kind of investing, and that's not only a retail phenomenon. Corporate executives, corporate boards, everybody in today's world is really kind of hooked on the dopamine hits of instant gratification. It's much easier to build a company's earnings through acquisition, in most cases, in a compliant market, which we've had, than it is to generate organic growth. And since growth is the name of the game in business, they're going to keep going back to that as long as it's available.
Sure. And maybe just to round out some of the data points there. So through the end of the third quarter of this year, we're already at 4.4 trillion. So I had given the number before about, over 3 trillion the last, 8 years kind of as a minimum, but this year, 4.4 trillion to the end of the third quarter alone. That's up over 90% kind of year over year. And these first 9 months of 2021 have surpassed the full year M&A record since really they've been tracking it going back since the early 80s, as you point out. That was in 2015 of 4.3 trillion. So this really is going to be a banner year for deal making.
I also think that there's a little bit of a rush now to get through the gates with people concerned that the Biden administration may take steps in the antitrust realm or the Federal Trade Commission areas that people haven't seen in a number of years. And the Democratic administration isn't the only one. China has been cracking down unpredictably, kind of right and left on various parts of the deal business that emanated from that corner of the world. So I think there's probably a little last-minute press going on, or fear of a last-minute press.
Yeah, absolutely. And that actually brings me to another point here is, we've identified, as a firm, kind of 5 distinct, waves of deal activity, going back since the end of World War II, and all 5 of them have had, different drivers, but all have one thing in common, and that they end. That's the only way that a new wave can ultimately start. So as we think about kind of the current wave that we're in, which really kind of started coming out of the financial crisis, does this feel like, a game of musical chairs, or is this wave of deal flow going to be different than the past?
Somebody, and I never can remember who, very wisely said that this time is never different in the markets. It's always different, but it always rhymes, which may be more accurate. I think it's musical chairs. It is a cyclical phenomenon, as you rightly point out. And that's not necessarily bad news for ARBs. As Mario loves to point out, and Jamie Dimon pointed out when I talked to him for Merger Masters, the market's cyclical, and when something happens, whether it's failure of a big deal or a treasury market action that crimps the deal business, or any of the number of other things, long-term capital's demise, that cause a cycle to end. Spreads blow out, and ARBs who are well positioned at that point and have the financial wherewithal to look at the deals left stranded on the table can often clean up very substantially by carefully picking through the ruins and buying some of those deals. So people like Mario and Jamie love to wait for those opportunities.
Yeah, that's a fair point, and I think that's one of the tenets or really the pillars of M&A investing, is that deals get done in good markets, in bad markets. It's a strategy that lends itself to that, and it's non-market correlated. I mean, that's really the dynamic that it doesn't matter what the market's doing. If you have an agreed upon merger, and you have a merger agreement, and you have a timeline and a set of hurdles to pass, in times of market stress, those hurdles may be higher to jump over, but certainly deals can still get done. And to your point, spreads may widen just because, there's kind of, this aversion to risk, but there still is an opportunity to earn a return. And how we earn a return in that spread really is, the time value of money, and understanding, investing in that risk premium for owning that security. And if you're willing to take upon that risk and understand what those hurdles are, at the end of the hunt, and on average, as you know, mergers tend to take somewhere between 60 and 90 days, let's say on average. And so your money versus, let's say, the alternative of investing in treasuries, near zero, you can have a very high annualized rate of return for investing in, what a lot of arbitrageurs would consider kind of a safe, transaction,
right?
All things held equal.
That's one of the things that makes it very attractive and countercyclical, as you point out.
Sure. You touched on in your last answer here one of the merger masters. So why don't we kind of round out our conversation today? And having spoken directly with all of the merger masters from the book, a lot of them were on various sides of the transaction, participated in different ways, and maybe just as a start, what in speaking to them, kind of what made a good deal and what really were deal breakers.
It's kind of funny. There's probably as many varieties of deal breakers over the years as there are varieties of people who are trying to put deals together, because as Mike Price probably most dramatically pointed out, that it is a people business, and you have to understand the motivations of the people when you start looking at whether or not a deal is one that's going to work or not. But Jamie Dimon probably had one of the more colorful explanations. He says he has a cockroach theory of investing in ARBs. When he sees one problem in a deal, one hiccup, he gets out because he's sure that there are always more to come. But he also tends to avoid deals where a contract is really just an option. All ARBs spend a lot of time looking at contractual details and the legalities involved, but it's really not whether there's a contract, but what does the contract say, and who has the ability and or the incentives to either close the deal or break it up. He's also more, and anybody who has as Jamie put it, get out of jail free card is not someone he wants to have in a deal with him. He's also more careful on pure cash deals than a share contract. Obviously, a share-for-share exchanges are a relative agreement, relative value agreement. And if that can be more insensitive, as we were talking about, to what the market overall is doing, whereas a cash deal can sometimes be hard to finance if all things are going crazy in the market. But he talked with a lot of relish about having a large plate of possible deals to invest in after the financial crisis, in the immediate after the financial crisis, when there were a whole lot of ARB deals hanging open and uncertain about whether they would close. And he said he and his team went through and played deal or no deal, psyching out the participants in each of the deals. And for example, they said, what about Chris Flowers? Does he really want to take over Sallie Mae? Hell no, not in this environment. So they didn't invest in that, but they did invest in quite a few others. The majority of the ones they looked at worked out very nicely for them.
Yeah, you mentioned one thing in regarding, kind of deals and thinking about, which ones are going to close and picking the highest ones of that probability. And in speaking about, financial transactions, the ones that are highly strategic in nature, tend to be the quote unquote good ones because you have a business that's looking to add to what they already know. Not to say that a financial buyer doesn't know a business, but financial buyers, like a private equity, let's say, they have probably more wiggle room to, walk away from a deal, because if the deal crosses over a quarter or some other financial period of importance to the company, they're probably more likely to back away if there's kind of a surprise. Whereas a strategic buyer who's operating in the industry or maybe in one of the verticals of that industry likely already knows that there could be the possibility of a surprise, to the downside, let's say. But again, strategic buyers tend to be buying these businesses not for the next 2 or 3 years and then looking to kind of, repackage it or re-IPO it. They're looking to buy it for the next 10 years or possibly longer.
Right. They're buying it to grow their businesses rather than make a quick killing.
Yeah. And as you said, a lot of the deals that were kind of still about following the financial crisis, it's when you think about last year, when everything was beginning to be shut down, there was a lot of deals that, the buyers of the targets were looking at breaking the agreements. And they were looking hard at the what the lawyers put in for the MAC clauses, or the material adverse change clauses, to see, how do we now get out of this deal? Because this, blindsided everybody on the impacts economically of certain transactions. And as we saw, there was, widened spreads for fears that deals would break and fall back to where they were trading pre-deal, or even worse, because if the business was crippled in some way economically, clearly there should be more of a sell-off with that. But a lot of deals that had, strong MAC clauses, meaning the buyer could not really easily walk away without jumping through a lot of hoops or going to various courts in various jurisdictions. A lot of those deals still wound up closing. Maybe they didn't close on time. And other deals we saw renegotiate. So some of these stalling tactics around the MAC clauses were tactics really to get a price break to say, look, yeah, we agreed to pay, but we still want to buy you, but at a lower price. And having an active approach to investing in deals can be very advantageous. So reading through all these public documents, being familiar with the process, understanding, again, some of these more strategic deals where, again, if it's purely financial, you may say, all right, we're going to cut the cord and maybe pay a breakup fee and walk away. But for more of these strategic deals that are of highly importance, as we talked about, like you had said, this buying versus building notion of the wave that we're in was of real importance to a lot of companies. And on the investment side, being an arbitrageur, there was a lot of opportunity to invest at significantly wider spreads that otherwise you'd have never had the opportunity. And when the deals closed, you reaped, extreme double-digit returns in some instances.
Yeah. The other thing is that as kind of down to the mechanics of what the ARBs are doing, all of them, but I can point to, Jamie said it too, they invest incrementally in deals. Even if they are going to end up investing very heavily in a particular deal, it's a dynamic process. They're assessing the deal constantly, the situation constantly. If something, as long as things look good to them, they'll continue investing in it and maybe, depending on their strategies, end up with large positions before a deal closes. But one thing they also do, as Jamie said, is the discipline is that if facts change and you wouldn't own it, you sell it. It's really simple. People hate to sell something that's down $1. They've got no problem selling it up $1. But if it's down, they're hoping that at least they get their money back. Mm-hmm. But remember, hope is not a strategy. It's dumb. It's very simple, actually, but it's hard to do in reality sometimes.
Of course. Well, Kate, I think we're going to leave it there because we want you to come back. We thank you for joining us on this inaugural visit for you. It's really been our sincere pleasure to host you on the Gabelli podcast. Thanks to all for listening with us today. As I mentioned, Merger Masters is available. I encourage you to connect with Kate directly at her website, wellingonwallstreet.com. And the Gabelli team can also certainly be reached, of course, at gabelli.com, or feel free to call us as well at 1-800-GABELLI. Thank you all and have a great day.
Thanks, Jeff.
Several companies were mentioned in this episode. We own less than 1% of the following: JP Morgan, ticker JPM, Robinhood, ticker HOOD, and Sallie Mae, ticker SLM. Following today's discussion, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of the stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of October 12, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual company or stock is not an indication that it is currently held in a portfolio, nor is it an indication that it will ever be held in a portfolio.